Hello everyone, Monty here from IG, and today we're going to look at explaining options, exactly how options work in general, like a call and a put option. And then afterwards, we're going to go through looking at options on IG's trading platform. So two very different things, and you'll see exactly what I mean as we progress in this video. But that's essentially what we're going to be going through today. I do want to give a special thanks to those who have helped in giving a lot of information with regards to the two trading options on IG's platform, as well as a lot of the questions that you've had that you've presented to them. I mean, they forwarded a lot of those questions and let me know your concerns. So a special thanks to Tyron Searle. He's the IG Trading Services team lead in South Africa, as well as James Fisher, our very own operations manager here in IG Dubai. If you do have any questions, do let us know. But for today's agenda, really the first part is going to talk about just explaining options. So we are going to look at a spot and a futures contract so you can see the difference between a spot, a futures, and an options contract. And then we're going to delve into options. We're going to look at call options. We're going to look at put options. We're going to go through examples of both, two examples of whether you're buying or selling a call option or buying and selling a put option. We're also going to look at the reasons why people use options, whether it's to speculate, whether it's to hedge, as well as certain spreads and combinations. It's going to be a bit heavy in terms of terminology, but that's just so you guys understand the concept of options. However, if the goal here is really just about trading options when it comes to trading options CFDs with IG on our platform, that's the second part of this video, and we are going to explain exactly what the options table, how to pull up the chart, and what exactly what is exactly that you're trading. Why is it, for example, that you don't receive a premium or pay a premium when it comes to trading options on IG's trading platform? So with that in mind, let's go ahead and start off with a very, very basic spot transaction example. You've got a buyer, you've got a seller, and this stuff is usually very straightforward. You probably engage in it yourself. Buyer has cash, wants to, for example, buy gold, which the seller has, and in exchange wants cash. So in this case, very straightforward. The two of them on the spot, they go ahead and they exchange. Buyer takes the gold, seller takes the money, they part ways, and it's over. Let's take a look though on how it might differ a little bit with a futures contract example. And by the way, we're not talking about a CFDs transaction just yet. That's all going to come later. We're just talking about just in general to get ourselves to understand the difference between a spot, a futures, and an options contract. So for a futures contract, you've got a buyer and a seller, just like you had in the first example. The buyer wants to buy gold. In this case, though, at a specified date in the future. The seller wants to sell gold at a future date. It could be, for example, a gold miner and they're extracting gold. They'll have it available in a month or 2 months' time. It could be a farmer that's, for example, that's growing produce and they're going to have it at some certain date in the future. So this is about a transaction that's going to take place in the future. Now they agree now, and the buyer and seller are both obligated toward to this futures contract. The buyer is obligated to buy, seller is obligated to sell. And of course, in this case, the money's transferred over, but keep in mind that sometimes, depending on the type of contract, maybe they only have to pay a fraction of it to initiate this contract. But then eventually, of course, once the transfer happens in the future, the remainder of that money has to be transferred if it hasn't been paid in full by then. So this is all it's supposed to be happening at a future date. And of course, when you look at CFDs, you're saying, oh, well, we got spot, we've got futures, for example, when it comes to gold. In that case, the transaction you're doing there, you're using leverage. We're talking about, in that case, you're talking about spot and futures CFDs. But now we're talking about spot and futures contract. And then we're going to go ahead and move on to how it compares or how it contrasts with an options contract. So first off, it's a contract, kind of like what we saw when it comes to futures contract. It's between a holder and a writer. You could say between a buyer and a seller in terms of the option to buy or sell, depending on what's going on. But basically, you have a holder of the option of the contract. You've got a writer, and it can take place on or before a specified date, depending on the type of option. But in this case, one thing to keep in mind is, and here's the real difference, it's for the right, not the obligation, to buy or sell at a certain price. So the holder in this case, the buyer, so to speak, they have the right to buy or sell. They're paying a small premium for the right to buy or sell something at a certain price on or before a certain date. And in this case, if they exercise that right, if they say, you know what, and don't worry, I'm going to go through a bunch of examples, but if they go ahead and exercise that right, the writer of that obligation is obligated to go ahead and carry out uh, contract and to ensure that if the holder, for example, wants the right to buy gold at $1,300, the writer must therefore sell gold, is obligated to sell gold at 1,300. This is all, of course, provided that the holder exercises that right. And there is a premium that's paid, so the holder is paying a small premium for the right to be able to buy or sell at a certain price. In other words, the one that's holding the option can choose during this time before expiration whether to exercise that right, or they could say, you know what, I don't want to exercise the right. I'm just going to walk away and I'm going to lose that premium. So, for example, paid a small premium for the right to buy gold at a certain price, and during this period of time it doesn't make sense to buy gold at that price, they could just say, okay, you know what, I'm just going to go ahead and walk away. And just a bit of terminology before we go through the examples, which is really going to help you guys understand this concept. But the cost is called the premium, the cost of that the cost of buying the right of the right to buy or sell at that price. So not the cost of buying gold at say 1300. You're still going to, if you end up exercising the right, you're going to pay 1300 for gold. But aside from that, you're paying a small premium for the right to do so. There's an expiration date or maturity, and the agreed upon price that you have the right to buy or sell at is what we call the strike price or the exercise price. And here we're gonna look at two different options of two different types of options. If you're looking at the right to buy a price within a certain period, that's considered a call option. And if it's the right to sell, that's called a put option. So a lot of terminology, a lot of things going on. Best thing to do is just let's go ahead and take a look at an example. This will really help clarify things. And in this case, I'm going to take gold prices. This is a monthly chart. It's back, if I'm not mistaken, a few years back. And we're going to take a call option example. And what's happening here is the holder is saying, okay, I want the right to buy gold at $1,395. So he's in this case, he's paying a premium for the right to buy gold at $13.95. The writer receives the premium. Remember, the holder has not paid for gold yet. This is all just for the premium. And of course, the expiry is, and this is just an example, 6 months from now. Now, you'll probably notice on the platform, you're saying, oh, there's a daily expiry, weekly, and we're going to get to this monthly. Here I put an example, just 6 months, just for the sake of an example. And let's see what transpires over this 6 month period. And you can see that gold prices are going lower. They're going lower. A bit of trying to retrace a little bit, maybe towards the end, a slight retracement back up, but essentially settling around $1,220. And in this case, the holder is looking at it going, okay, I have the right to buy gold at 1,395, but why would I do that? Why would I buy at 1,395 if the price is lower? I would only exercise that right if gold prices went above that. And we are going to go through an example of that, by the way. But in this specific example, it doesn't make sense to exercise this right. So gold prices ended lower. There's no point buying at 1,395. So the holder says, you know what? I paid a small premium. I was worried about downside risks. Those downside risks materialized. Therefore, it makes no sense for me to exercise this right. I'm going to go ahead and walk away. The writer in this case keeps that small premium and holds on. In this case, if the writer had gold, holds on to the gold in that case. And you might say, well, afterwards gold prices went higher and so on and so forth. Well, it expired. So that it no longer matters what happens afterwards if gold prices go up or down. The maximum loss for the holder in this case is just a premium because they paid that small premium. In other words, they wouldn't have lost. They wouldn't have been this big move from about 1300, briefly into the 1100s, 100 plus move. They wouldn't have suffered any drawdown or any losses. Maximum loss is the premium. The maximum gain for the writer is also the premium. Let's go through another example in this case, another call option example, this time with gold prices. A year later, we're going to look at a monthly chart and we're seeing gold prices hovering roughly around the $1,300 period. And in this case, once again, we're going to go ahead and we're going to take a look at a holder with the right to buy gold again at 1,395. So in this case, the buyer is paying a premium, once again saying, okay, look, I'd like to have the right to buy gold at 1,395. The seller receives that premium and the expiry is 6 months from now. Once again, it's just an example. So let's see what happens to gold prices. It was a year big on monetary policy decisions. Gold prices, went significantly higher, briefly above 1,500, but generally speaking, settled around, let's say, 1,510. So within by that time it settles at around 1,510, and now it makes sense to exercise that right, because if you have the right to buy it at 1,395 and it's currently well above that, so you exercise the right, you buy it at 1,395 and you sell it off at, for example, 1,510, and minus, yes, you had to pay a small premium, but you take aside that premium, overall it's a significant profit for the holder, and the seller, as the writer of an option, is obligated now, because you exercise the right, the seller is obligated to provide the gold, and the transaction occurs. So the holder has paid a small premium, and they've paid not 1,510, they've paid $1,395 for that gold. And the maximum gain in this case for the holder of a contract, in theory, is unlimited, because gold prices could have gone a whole lot higher. They could have, within that period, it could have gone to 2,000. You might say, well, it's not going to go to infinity, for example, but technically, in theory, the gain is unlimited, whereas the maximum loss for the writer is unlimited. And that's really the danger of being on the writer side, if you will, or on the sell side of a call option. And it's not as dangerous with a put option, but still dangerous nonetheless. And that's we're going to go through now a put option. So with a call option, it's the right to buy at a certain price. Well, what if you want to short at a certain price? What if you want the right to short at a certain price? In this case, you're going to use something called a put option. And we're going to go through two examples here, just like we do with the call option. So first example, you want the right to sell gold at 1,250. Prices are right now hovering at around 1,300. You think it's going to go lower, but you don't want to initiate a sell position because you're worried, what if gold prices shoot higher towards 1,500 or something? What if I end up getting stopped out? What if I end up taking on a lot of loss or big drawdown? I don't want to do that. You know what? I'm just going to pay a small premium for the right to sell gold at 1,250. If it goes below that, great. If it doesn't, well, I just lose a small premium and I'm on my way. The writer receives the premium and expiry, as an example, once again, 6 months from now. So let's see what happens to gold prices. They edge lower. I've taken this from the previous example. You see that they've edged lower quite a bit, retracing a little bit off the lows, and by the end it ends about slightly lower. You can say around 1210, just guesstimating based on the graph. And gold prices end lower. Holder says, you know what? I have the right to sell at 1,250. Let me exercise that right. I do have to pay a premium, but in the end, assuming that the premium isn't that large, doesn't cover the gap, he goes, okay, you know what? Let me go ahead and exercise it. Let me go ahead and the right to sell at 1250, and let me pocket the difference minus the premium paid. And let's see what happens to gold prices afterwards. They do edge higher, but once again, it doesn't matter because it's after the expiration date. So in this case, the maximum gain for the holder and the maximum loss for the writer is going to be a move towards zero. So if gold went to zero, hypothetical, again, it's just hypothetical, the most you could have made is 1,250 minus the premium, of course, but that means also the maximum loss would have been on a move towards zero would have also been 1,250 minus, of course, the premium that they've received. So let's go through another example. Once again, it's gold. Once again, we're going to go with a put option, and in this case, that's the right, again, when you're buying a put option, it's the right to sell at a certain price. So in this case, you look at it and you say, I think gold is going to move lower. I want the right to sell at 1,265. So the buyer pays a premium once again for this right to sell at 1,265. Once again, the expiry as an example, 6 months from now, and gold prices shoot higher. So we're going with that other example where gold prices went up. And in this case, had you gone with a short position at around that level, at around say 1,300, you would have been in real trouble because you would have been exposed to this move. In this case, they're saying, no, I'll just pay a premium for the right to sell at 1,265. If prices, should prices go lower, if they don't, I don't need to exercise the right. Gold prices ended higher. They're at around 1,510. Well, why should you exercise it? Why should you sell at 1,265? You're not obligated. This isn't a futures contract. This is a options contract, and you have the right to sell it at 1,265. And you say, you know what? I'm not obligated. So what I'm going to do is I'm just going to walk away. The holder walks away. Yes, you lose that small premium. The writer gets to keep the premium, but at the end of the day, you avoid what could have been a pretty big loss had you initiated a sell position and held on to it. So the maximum loss for the holder is just a premium. The most you can lose when you buy a put option or a call option, the most you can lose is a premium. But when you're the writer, the most you can make is the premium received. The most you could lose is unlimited when it comes to a call option, if it goes towards zero, quite significant when it comes to a put option. So in summary, when you buy a call option, you're paying a premium. It's the option to exercise a buy at a certain price, and you obviously want prices to move higher, right? That's the general idea. Especially, of course, when you bring into account the strike price and what the price is, you want it to go above the strike price. But generally speaking, deep down, you're like, I need prices to move higher beyond the strike price to make up for the premium and hopefully a whole lot more. When you buy a put option, again, you're paying a premium. Whenever you buy an option, you're paying a premium. You have an option in this case to exercise a sell, and you want prices to drop, right? Because you've exercised a sell at a lower price, just like we saw in the put option example. You want it to go below 1265, for example, in the previous example. If it doesn't, okay, you walk away, but that's ideally what you want. You want prices to move down and below your strike price. Now, if you're selling a call option, you receive a premium. You're obligated to sell if the holder exercises, and you obviously want prices to drop. You don't want prices to go towards the call option or above, towards the strike price or above, because that means now the holder of the option is going to exercise it, and now you're forced to buy it up at a higher at what could be a higher price. And you also want, when you're selling a put option, you receive a premium once again. You're obligated to buy if the holder exercises, and in this case, you would want prices to rise. Now, crucial to note that you only risk the premium when it comes to buying an option, whether it's a call or a put option, whereas you end up risking a whole lot more, in theory, unlimited when it comes to a call option, and could be quite significant according to a put option, depending on where prices are, but you end up risking a whole lot more when it comes to selling an option. And as a result, buyers of an option, whether it's a call or a put, they're hoping for an increase in volatility in the direction of their strike price. So if it's a call option, you're hoping volatility, a trend-like move toward, in the direction and above your strike price. And if you bought a put option, vice versa, you're hoping for increase of volatility, but in down a trend-like move downwards beyond the lower strike price. While sellers want prices to remain range bound or hopefully ideally trend opposite, and whenever volatility spikes, it's a bit of a scare. Even if it spikes in the opposite direction, it means that once volatility spikes, things could start could start moving, and then you start to worry about whether or not prices could move opposite and start to move in direction of the holder of the option. So why would someone use an option? Why not just buy or buy whether it's spot or futures contract? Well, let's take an oil producer who buys a put option to protect against downside risks. The oil producer says it costs me $40 to produce a barrel of oil, so I'll buy an option to sell at $45. So in this case, one of two things happens. Let's say prices go up to $60. Well, you paid a premium for the right to sell at 45, but well, it doesn't matter. You just sell your physical oil at 60, and you walk away from you don't exercise the right to that put option to sell at 45. But what if prices drop to $30? Well, it costs you $40 to produce a barrel of oil. Now you're losing $5 on your physical uh, production of oil. And by the way, this did happen when oil prices went lower for U.S. shale and U.S. producers that hedged their production. There were those out there that had an option to sell at, for example, $45. So what they did was they exercised the right to sell at 45, right? And then they closed out the position at 30. So they made $15 well, minus the premium, but they made as on the between the strike price and between the price in the market, they made $15 there, and at the same time, even though they were losing on their physical production. The second reason why people might do it is for speculative reasons. If you're looking to make money, you think, oh, prices will go up, but I'm worried about downside risks. I think, for example, you believe gold prices are going to go higher, but you're worried that it could make a nasty squeeze lower. So you buy a call option and you only risk the premium. Um, and of course, it's a combination as well. If you think it's about to get volatile, let me buy a call and a put option. So either direction is going to, if it moves significantly beyond the strike price in either direction, to the extent that it offsets the premium, then that way I can go ahead and try and make money. And just a side note, what's the difference between an American and a European option? In American, you can exercise it at any time from purchase until expiration. That's why in the examples I said up to expiration, depending on the contract. If it's an American contract, you can exercise it at any time. So if for example, gold prices go up beyond your strike price before the expiration, 1 or 2 months into the purchase of the options contract, you can exercise it an American options contract right there and say, okay, I want to buy it now at a lower price and I want to sell it off at the current higher market price. Whereas if it's a European one, you can only exercise on the expiration date. So that's just something to note. And just some more terminology. Some of it's repetitive, but premium is the price that you pay for the option, not for the product itself. Once you exercise the option, then you have to pay the strike price for the product. And intrinsic, two parts here. Intrinsic value is the difference between the current price and the strike price, and the second part of the premium has to do with time value. It's the value based on the amount of time left, because if there's more time, there's a greater possibility of a change in its intrinsic value, right? Because when expiry is approaching, the likelihood of there being a big move drops, so the time value drops. And then there's also implied volatility. You'll see it also on the trading platform. IV stands for implied volatility, level of expected future volatility based on current price of an option. It's the likelihood that the market expects a price swing. It doesn't mean that it's going to happen. I mean, just because the market expects a big price swing doesn't mean that that's going to occur, but it is something that the market notes. It's something that traders note, and it is something that goes into the calculation of a lot of these premiums. So the higher the number, the higher the option price because of a potential move. And finally, these last few items, in the move, in the money, out of the money, and at the money. In the money, it's an option where for a call option, the market price is above the strike price and hence favors the holder. A put option, the market price is below the strike price and hence favors the holder. So it's in the, when you say it's in the money, kind of think of it like, oh, the option is already making money in this case. So because the price is already above the strike price in the case of a call option, or below the strike price in the case of a put option. Out of the money is where there's no benefit of exercising the option because the price is either below the strike price in a call option or above the strike price for a put option. Basically, it hasn't reached a level yet where it makes sense to exercise it, so it's out of the money. And in that case, if it does expire, the holder's just going to walk away and say, I'm not going to exercise it because the option is out of the money. At the money is when the market price is about the same as the strike price. So that's just a bunch of terminology. I do want to point out that there are a bunch of combinations that people do use straddles when you buy a call and a put option with the same expiration date, same strike price. And the idea here is you're expecting volatility that's going to send its price away from market price enough to at least offset the premium that you paid on both options. Because if you buy a call option and a put option with the same expiration date, same strike price, you're paying a premium for both of those. So the hope is that, okay, I'm hoping that market price, there's going to be volatility, there's going to be a spike in volatility that's going to take price beyond the strike price in either direction, whether it's to the upside or downside, to the extent that you're hoping that it's going to offset the premium that you paid on both options. A strangle is where you're buying both with the same expiration, but the strike price is different. And this usually occurs if you think there's more, for example, upside potential or downside potential, depending on how you do it, because you'll change the strike price saying, okay, let me go with a lower strike price for the put option and a slightly higher only strike price for the call option. And that's just because of your expectation of where you think the market's going to, when you have a slight bias. So straddle, really, you're just going based on volatility. A strangle, you're saying, no, you have a slight bias in terms of where you think the market's going to go. You got a calendar spread where you're buying and selling options with different expirations. And then you got what's called a butterfly, three strike prices that are equally spaced. For example, 1260, 1250, 1240, they're spaced apart by $10. All three are either calls or puts, and they have identical expiration. And what you do here, if you're long the butterfly, you buy one of the high priced, one of the low priced, and sell two of the middle priced. And in this case, you're attempting to profit off of volatility. So that's if future volatility is below implied volatility. Any short butterfly is the opposite. Uh, you're again, in this case, you're going to go ahead and you're hoping to profit off of future volatility above the implied volatility. So with that in mind, we're out of the way when it comes to the understanding options. Now it comes to trading options CFDs with IG. And here you're going to have to shift your mindset a little bit. The reason why I went through all that is to help you understand how options work. And some of you may already know how options work. And that's why when you got to the platform, you've got these questions and you're wondering what on earth is going on over here? Why is it different from what you're expecting? Where's the premium that I got to pay? Where's the premium that I got to receive if I'm selling an option? So on and so forth. Let's first of all get things set up. At the side, you'll see that there's the option. You check on that. And then, of course, you can filter by asset class for our example. So let me go back a little. You can see indices. You can see GBP USD. You can see the Germany 30, crude, so on and so forth. What we're going to do is we're going to filter by asset class. So let's just take FX in our example. And then if we're going to choose for filter by the maturity or the expiration, we can choose, for example, weekly. So I only want to see weekly contracts. And then, of course, if we select the Euro USD, you can see that the options ladder comes up, and we are going to go through this table. And of course, you can add it to Workspace so that you don't have to always go through this process. You just add to Workspace, and they'll be added to your workspace. So up next, then, one thing you can do is you can scroll for different you can scroll through the different weekly options table when it comes to your USD expiry. And over there it shows March 5th, 2021. If you're watching this video, obviously afterwards, this is already expired. But what you can do is you can go ahead and you can click on it and you can go, for example, to the March 12 and and 17, so on and so forth. That, I mean, again, depending on whenever you're watching this, you'll probably see something maybe even in 2022. All depends when you're watching this video, but bottom line is you can go ahead and you can scroll through the different weekly contracts in terms of when you want that expiration date. And top right, you'll see deal as well as information section, info for information. In this case, it'll give you an idea in terms of what the minimum size, the contract size, as well as the expiry date. So in this case, March 12 for the one that we've selected, as well as the time. And it tells you right there when the settlement is based on the midpoint and the price 10 a.m. Eastern time, New York. Again, I'm using this is out of IG Dubai, but settlement time ideally should be the same. Up next, when you look at the options table, you'll see a reference line, and I've highlighted in blue just so I can show it, but that tells you where the current price relatively is. And up here, you'll see the price in this section over here. But over here, in this case, it'll show you, it helps you lineate or helps you visualize the call options that are in the money. So these are call options with a strike price at, for example, 115. So that's already automatically in the money compared to where prices are right now. It shows you put options that are out of the money. In that case, for example, um, 115.50, that's below the current price. The right to sell at that price, that means that it's a put option that's out of the money. Price is going to need to go below 115.50 in order for that put option to be able to be in the money. You got call options that are out of the money. So for example, 123 at a time when price is at 120. So that means that this is a call option. Prices need to move up in order, and I know you're looking at it flipped going, what's going on? Well, you're looking at it from lowest to highest. So in this case, prices need to move higher. They need to go into the 122s or 123 in order for some of these call options to be in the money. So they're out of the money. Those call options are out of the money, whereas the put options are in the money below that line. And of course, it's here that I really, really need to stress on the most important part of all this, because you're looking at this going, what exactly is going on? First off, you click on the option that you wish to buy or sell. So let's say you want to buy a call option that's already in the money at 117. Under deal, you click on the graph. When you click on this, the deal tab is going to come out, and you're going to see this section right over here. You click on that, and this is what's going to show up. It's this graph for the weekly Euro USD 117 call. This is what you're really trading. I'm going to clarify a little bit more with some more items in future slides shortly. But what's happening is you're trading this graph. So you're trading the premium of the weekly Euro USD 117 call that expires on March 12, 2021. This is the buy price 166. This is the sell price. Now, how the pricing works and all that, we'll get to that in just a second, but this is essentially what you're trading. So there is no, you're trading the difference in price. You're not receiving a premium. You're not paying a premium. We're going to get to all that stuff in just a second, but this is the reason why I said you kind of have to change your mindset in terms of understanding how to trade options, CFDs, versus when we talked about options before. And I went through that before because you need to know, people out there have been asking, okay, what are options in general? But so we go through that, and then afterwards we go through this part, which is explaining how exactly this works. So another thing to note, by the way, if you're looking to bring up the graph, when you open up a position, you can also bring up the graph by clicking on the position in the options tab, and that chart's going to come up, and you can go ahead and click add to workspace, and it's going to be there. And this is also where you can close your position. So you can click on close for the option position you no longer want open in order to be able to close it. But in this case, when we go ahead and we click on, for example, a 116 call option that's in the money for Euro USD on the weekly at 263 point, you can see 263.4 there. If you opt to buy an option, whether it's a call or a put, what's the margin here? Because you're trading on margin, right? Well, the margin here is the point, which is $10 in this example, multiplied by the buy price, and that is going to be your margin. So the maximum you can lose is the premium. However, I need to point out, you're not paying this. 2,639 is not something that you lose as a premium. You're not paying a premium in order for the right to buy at that price. This is the margins, which when you close your position is going to go back into your account in terms of in terms of funds and available margins. So I don't want you to look at this as a penalty or a payment, but that's just something that you're putting aside in order to initiate this contract. And that's how the margin is calculated in a buy position, whether you're buying a call or a put. The next question is, well, how exactly? And this is a question that Tyron and James told me. This is a common question that clients will ask. Well, okay, fine. You understand how exactly a buy position, how the margins are calculated. How exactly is a sell? How exactly is that going to be calculated? In this case, when it comes to a sell option, because it could go a whole lot higher in terms of the price. So how exactly do you calculate that? Margin in this case is calculated by taking the point and multiplying by the underlying margin rate for shorting. So we look at the underlying contract, we look at the shorting for the underlying contract, and the margins are calculated based on that. So when it comes to the buy position, you're taking the point and you're multiplying by the buy price of the premium. So the maximum you can lose is the premium. But in this case, the most you can make is going to be moved towards zero. And as always, the price of this premium could go higher and higher and higher. So there is no limit, and you need to keep that in mind whenever you're selling an option or whenever you're selling even for example, a weekend Euro USD 120.50 put. Now, there are no commissions charges when it comes to option CFDs with IG. The spread is the difference between buying and selling the premium. I've highlighted that over here. It can widen at times due to the underlying, if there's a lot of volatility, so on and so forth. But that right there is going to be the difference between buying and selling the premium. And remember, you're trading based on IG's pricing. Yes, it's very much correlated to the underlying. In some cases, almost identical. But there are going to be some cases where there might be a little bit of a variation, a little bit slight differences. And at the end of the day, you're trading based on IG's pricing, which is based on, once again, it's correlated based on the underlying market. Now, $10 per point means that from 191 in this example, if you're selling from 191 to 192, so it's not 191.1 to 191.2, for example. And when you initiate a position, you notice that if the spread is 6, you're down $60. And this was a lot of question that people had. They open a position, they place a deal, and they see that, oh, I'm down $60. What exactly is going on? That's the spread. It's like whenever you're trading Euro USD spot and the spread, for example, is point 0.6, excuse me, 6 pips. So the moment you initiate a one lot contract, you're down, for example, what's it called? You're down $6. If it's 1 pip, for example, you're down $10 on a Euro USD when you initiate one. Here, the spread is 6. So when you're initiating one contract with a $10, where it's $10 per point, it might be different when it comes to oil and all the and different options contracts. You're going to be down the spread the moment you initiate by 60, because if you were to sell, for example, at 191 and you want to close your position right away, you're closing at the buy price, which is 197. So that's going to be 60. Now, if the market moves in your favor, so if you're selling at 191 and it goes down, for example, to 180, that means plus a 6 pip spread. That's 186. In that case, you would be making you'd be up $50. So you go from being down 60 to being up 50. You're waiting essentially for just like you would in a regular non-options contract on IG's trading platform. With a spread, you're waiting for it to move in your favor. Now, I have to point out once again, you're not receiving a premium if you're selling. You're not paying for a premium if you're buying. You're just paying for the cost of the spread. So when you see negative 60, when you initiate a position, that's what it is. And when you're putting aside funds for margins, it's just that. You're putting aside funds for margins. You're not paying in this example, $2,371 from your account to initiate a sell put position. No, that's just being held as margin. Once you close your position out, whether it's in profit or in loss, for example, if it's a loss of $100, you've lost 100, that funds go back into your account, and now you can use those towards another position. And here are some things that you have to take into consideration. Options that are out of the money are generally cheaper, and that's something to consider if you're worried about margin uses. Let's take the example over here on this Euro USD, and you can see that this is an option that's well in the money. It's a put option at 127. Price is around 118. It's cut off a little bit there, but it's around 118. So if you were to initiate here, the margin is going to be 8,386. So that's really big. You're going, oh, that's really, really big margins. Again, you're not paying this. It's not like a premium where it's going out of your funds and you've lost it. You will get it back once you close the position, but it might be a really, really, really big amount for you to pay in terms of margins. You don't want to go ahead and do that. If that's the case, consider options that are either closer, like over here it would be 680, or even consider those that are out of the money, around $146, for example, to buy, or in this case, $86 to go ahead and sell a put option there. But too far away, out of the money, so to speak, and it's too far out of the money for it to have a bid price. So that's something else to note in terms of going way out, in terms of being out of the money. Now, combinations that we talked about that exist in traditional options, they can't be exercised here. However, they pointed out that some traders out there, what they do is, for example, they'll buy an index in the spot market, but then they turn around and might use it as a partial hedge here. So it might be used as a partial hedge. Again, that's up to you. If you even want to dabble in these, or if you want to go ahead and use them, you could use it as a partial hedge. You could use it for speculative purposes. That's up to you. And with few exceptions, there are no limit orders. You'll probably notice that with other, when you're going to open a Euro USD spot or futures contract, you probably notice there's a deal tab, the order, and then afterwards there's alert and there's information. In this case, you've got deal and info. Very few exceptions where there are going to be limit orders on options. Now, premium prices can change based on volatility. So you might want to keep that in mind if it follows a volatile event. So if everything starts to come down after a sort of volatile event, or goes up, vice versa, depending on what's going on or what fundamental factors to consider, just keep that in mind as well. You obviously want to consider maybe doing this on a demo account before you go live, just to see how the premium prices change. So even if you are certain in terms of where you think prices are going to go, you might want to take into account, okay, how are the values of these premiums going to change? That's really what you need to know. And that's why I said it's so important to take out that graph and note the graph. You can try and trade, for example, those ranges, but you want to note the graph and see exactly what is it that you're trading. You're not, yes, it's based on the underlying market, but you want to note that graph and see exactly how the premium prices have changed. The last main thing I want to note is when it comes to expiry. By expiry, the position is, or I should say at expiry, when the position is closed according to the settlement price, if you if you're, for example, closing out a buy position prior, it's closed out at the bid price. If you're closing out a sell position that was made prior, it's closed down at the ask, it's done at the ask price. But keep in mind, just because your option, the premium that you bought was in the money, it doesn't mean your position has made money. Remember, you're trading the difference in the price of the premium. So if it's in the money, let's say you bought it at 116, and then it expires at the end of the week, and you go, hey, wait a minute, I'm in the money. Why is my position, for example, losing? Now, if market moved higher, if the value of the premium goes up, you would have made money, fine. But let's say hypothetically you're down $100, for example, your position went lower, and you go, wait a minute though, I'm still in the money. Yet you're trading the difference in the premium. You're not trading based on the options examples that I showed you at the beginning of this presentation. So just because it's in the money, it does not mean your position has made money. And also, just because it's out of the money, just because you bought something out here, doesn't mean your position has lost money or is worthless by expiry. You remember how I said with the options example, a call or a put option, when you're when you're not doing it, as a CFD, when you go ahead and if you buy an option, for example, you're buying the right to buy gold at $1,300. By expiry, if gold prices are 1,200, you can walk away and you lose the premium. And you go, okay, well now it's worthless. So the question is here, oh, does that mean that what I put down as margin or whatever, does that mean my position is worthless because I bought something that was out of the money? No, you bought the premium. In this case, you're trading the difference in the price of the premium. Just because in and of itself it's out of the money doesn't mean that the position is going to have lost money, or that it's worthless by expiry. Could be, yes, it's going to be closed at expiry, but it could be that you've actually made money, if it's gone in your favor. Because again, pull up the premium, the chart. That's why I say it's so important to pull up the chart. That's what you're going to be trading, whether that goes up or down. So I hope that answers a number of your questions. It makes a lot more sense, of course, to go out there and practice on a demo account and simulate and see exactly what I'm talking about. Graph it and take a look, and buy and sell, and take a look at the different options that are out there. The reason why I had to go through the example of what options are first, because a lot of people are wondering, why don't we just go through the platform and not go through what options are in the first place? Because there's a big difference between the options that I explained and then trading it on IG's trading platform. Well, the reason why we have to do it that way is because some of you out there may not have understood exactly what options are. I kind of had to go through that and then show you the difference between how it would work under a classic situation versus how it works in this case where you're trading the difference in the premium. So if you do have any questions though, do let us know, and thank you very much for watching.